It's great to be here. Thank you, AltFi, for hosting one of my favorite conferences. I do always find this one to be accretive. It tells me that it's fall because it's the start of conference season. I'm going to see many of you over the next few weeks and months. As was mentioned, I'll be focusing today on where capital supply stands for the industry, where it's headed, and share some thoughts on best practices and how we at Funding Circle continue to invest in our capital diversification strategy. Spending a moment on Funding Circle, we're the world's leading online marketplace for business loans, matching small businesses who want to borrow with investors who want to lend in the UK, the US, and across Europe. Since launching in 2010, investors including 50,000 individuals, the UK government, a range of financial institutions, and the European Investment Bank have now invested more than $2.5 billion in over 20,000 businesses. Now, the history of capital formation for the P2P and now marketplace lending industry is well documented, gaining traction initially with retail investors, evolving to a primarily institutional, capital-driven product over the past few years. This allowed several players to scale and separate from the pack, while also launching hundreds of new platforms. Many different routes have been taken, as you can see. With that, many of the players have scaled, finding many different successful paths. Now, to be clear, I don't believe there is one clear-cut solution. What is clear, however, is what has driven a platform success through today will not necessarily be what drives the next leg of growth tomorrow. Now, that's not to say that current capital channels won't remain a key driver. I believe securitization, for example, will remain a key component for capital access, and I also think we're still in early days there. However, we will see a continued evolution, and we are spending a lot of money and most important, our time and our operational resources to make sure we can access all types of investors, either directly or via strategic partnerships. We're also now in different times. The increasing awareness of the industry, its growth, and its stumbles by industry leaders have led us into a period of greater scrutiny. A period that I think all of us can say was not unexpected, puts capital supply and diversity of funding at the focus and forefront of every marketplace lender's executive management team. Institutional capital has been a key growth driver. Its volatility has now shown itself over the past few months. And with that, reliance and concentration on only a handful of capital providers proving to be unreliable. So diversification is critical, but it's hard. And true diversification can be operationally intensive and very expensive. But it will be the only way our businesses can consistently scale. At Funding Circle, we are fundamentally aligned with the true marketplace lending model. We've achieved to date diversification of funding via a publicly listed investment trust in the UK that purchases loans globally, that's ticker FCIF on the London Stock Exchange, a mix of institutional investors, including hedge funds, banks, traditional asset managers purchasing globally and country-specific, again, some using securitization as an outlet, private funds and accredited investors in the US, and government capital and retail capital in the UK and across Europe. While we have strived to maintain diversity across different capital providers, as I mentioned earlier, we must continue to evolve and are just at the tip of the iceberg in terms of investor reach and distribution channels. Now, as a lender, we all must strive to tap many of the different investors and capital providers that are listed here. And at minimum, lenders must fully have to understand the operational, structural, product, and regulatory requirements for each, and then evaluate the actual resources and costs to onboard each respective channel. Now, here are some of the key considerations as we think about expanding our relationship with existing investors and also entering into partnerships with new ones. You could spend hours on discussing each of these. If you think about each platform, what they have to do, they have to have a focused and honest analysis of where they are as a business and if they can fulfill the critical requirements for each type of investor. All of this strategic capital formation takes certain things you can control. Where are you allocating your money and your internal resources? To which channels do you want to spend your time? But there's also things you can't control. You can't have a 7-year track record if you've been in business for 4 years. Looking at this list of all the different types of institutional investors today, the largest pools of permanent capital are yet to play a considerable role in marketplace lending. Hedge funds and asset managers have been the key institutional capital suppliers to date. I expect both to continue to be key partners And in conjunction, lenders will need to structure ways to reach the other key institutional players listed here directly. The sales cycle and operational investments are considerable for the more permanent capital listed here. And none of this happens overnight, but the resources and the strategy must be implemented today if they haven't been already. We are taking many more meetings and attending many more conferences around the globe than we ever have before to ensure that we are on track to accommodate pensions, endowments, insurance companies, and sovereign funds directly. Now, retail, again, it's not just individual accounts. I think the last panel spoke to that in a very strong way. It's a key part of Funding Circle's investor base across UK and Europe today, and it's something that will be a key player and a key part of our US operations as well in the future. It also plays a key role for other players like Prosper and Lending Club. Now, for the most part today, the focus has been on direct channels. We're now spending much more time making sure we will have options that fit indirect models, and also that we are able to provide a suite of investment products. For the retail strategies we are yet to implement, we have a similar approach here as we do with our institutional investors. We build a roadmap, we understand what resources have to be dedicated in line with their requirements, and the requirements will ultimately be our strategic partners, and then decide if that's viable for us today. Let's dig into one of the channels. Looking at IRAs, for example. The low volatility, the overall size of the market, it makes it a very attractive channel which we look to market to directly, although partnerships can also be an option. But it's not without considerable requirements. Thinking about third-party partner integration we will need, such as with custodians, the internal tech and product resources to create the appropriate user experience and interface. And if you think about it also, the critical part, marketing infrastructure, to make sure you're getting the appropriate outreach and also the right customer acquisition. Now, along with all the scrutiny and volatility of the past few months, there are still pockets of strength. The current yield environment remains weak, while credit performance and yield in marketplace lending remains attractive. Those platforms dedicated to long-term growth should and do welcome the operational, performance, and regulatory scrutiny. And the overall volatility we've seen the past few months is further going to separate the winners from the losers, as those who lack the capital to invest in institutional-grade regulatory and operational requirements will be left behind. Lucky for us as well, appetite for yield is not just a US investor issue. There are trillions of dollars around the globe that welcome the yields and assets marketplace lenders make available. I'm spending much more time flying to Asia, the Middle East, Europe, Latin America, and hosting these international investors in our offices as well. When I discuss operational requirements and digging in there and understanding what you have to expend, it's important to make sure you're analyzing not just domestic here in the US, but how to accommodate various currencies and international structures as well. Partnering with recognized brands will continue to be a focus, as that increases validation and brand awareness for each of us. This is another area I think we're in still very early days. I expect us to spend much more time making sure we can accommodate all of our partners' operational needs and also regulatory requirements when it comes to banks. If you think about our government partnerships to date in the UK and Europe, it's made it a lot easier for us to raise other institutional capital. And it's also pushed us to improve our tech, operational rigor, and reporting requirements much faster than I think we might have. I believe regulatory compliance will be critical for scale and will separate the leaders as well. It's something that we have taken a very proactive stance on, and we've built a conservative regulatory and legal infrastructure in each of our local markets. There's a variety of regulatory requirements that can vary, whether it's for insurance companies, pensions, RIAs, banks. It's important that we're well-versed in all. The Marketplace Lending Association, the MLA, was launched in April 2016. Ourselves, Funding Circle, Lending Club, and Prosper as charter members. We're looking forward to expanding membership and include additional platforms soon. You heard from our new recently hired executive director, Nat Hoops, earlier. He's in Washington. He drives day-to-day communications with policymakers to increase education and awareness. So in summary, all capital sources and distribution channels have proven to be critical. Accommodating the technological and product requirements for sticky institutional and retail capital, a focus on having a sound regulatory infrastructure, and really the discipline to originate a strong credit portfolio with consistent growth is a path to scale and success. The industry is still in early innings. Capital supply and the diversity of funding sources, while in prior years was less of a focus. I believe now it will be the key differentiator between those lenders that achieve true scale and those that are left behind. Thank you.